Hello everyone, I am Sandeep Abange and today I will tell you if you should subscribe for the upcoming IPO of Home First Finance or not. Firstly, a brief on the IPO details. Home First Finance is planning to raise Rs 265 crore via fresh issue and up to Rs 889 crore via offer for sale for a total of around Rs 1154 crore. The IPO is set to open from 21st of January and it will remain open till 25th of January and the price band is fixed at Rs 517 to 518 per share for a lot size of 28 shares per lot bid. Now, Home First Finance is a technology-driven affordable housing finance company that targets first-time home buyers in low and middle income groups. It is backed by marquee investors like Warburg Pincus, True North, etc. As of September 2020, Home First 92% of gross loan assets consisted of housing loans which have grown at a CAGR of 63.4% between FY18 to FY20. Its AUM has risen from Rs 847 crore in 2017 to Rs 3730 crore in September 2020, showing a CAGR growth of 62%. Credit rating of the company has also improved from A- in March 2017 to A+ in September 2020. Its salaried customers accounted for 73% of its loan assets and rest consisted of self-employed customers. Despite COVID, this housing finance company has maintained above 96% collection efficiency, which is a good sign of stability for the company. Looking at India's housing market, it experienced a healthy CAGR growth of 16% in home loans outstanding for FY15 to FY20 on account of a rise in disposable income and as well as healthy demand and a greater number of players entering into the segment. The share of urban population in relation to the total population has been consistently rising over the years. Urbanization levels rose from 28% in 2001 to approximately 31% in 2011. Rising demand for independent houses and declining age of home loan borrowers bodes well for the Indian housing market going forward, which is expected to grow at a CAGR of 8 to 9% as per CRISIL's report. The housing finance market faces high competition from well-established players such as HFFC Ltd and the likes, while immediate peers for Home First Finance Company are Grover Finance, Awas Finances, etc. Now delving deep into peer analysis in terms of AUM, Home First Finance has grown at a CAGR of 63% as against a wide range of 8 to 50% of its peers, which makes it one of the fastest growing housing finance companies in India. Similarly, its disbursement growth stood at 111% in 2019 and disbursements per branch stood at Rs 25.3 crore as of FY20 as compared to Rs 12.7 crore for its immediate peer Awas Finances. Home First is a tech-driven housing finance company and has invested approx Rs 20 crore in the IT system since the last 3 financial years. Due to this, the company is able to capture over 100 data points of a customer in addition to other data. They have also deployed proprietary machine learning customer scoring models to assist their customers with effective credit underwriting. This has further helped them to reduce their average sanction time to 48 hours. Coming to the most important part for any housing finance company, its financials. So, Home First has grown its net interest income at a CAGR of 34% in the last 3 years. Similarly, its net profits have grown at a CAGR of 70% in the same period. It has maintained decent in net interest margins around 5% as compared to its peers Awas Finances, which has maintained net interest margins in the range of 6 to 7%. Its GNPA and NNPA remained close to competitive levels of its peers in the range of 0.8 to 1%. However, its credit cost is increasing steadily and hence it should be keenly looked at going forward. Moving on to the important ratios, considering its size, Home First has maintained a decent return on equity of 10.9% as of FY20 as compared to larger peers which have maintained return on equity in the range of 11 to 12%. This shows the company has proven its fastest growing housing finance company status. Additionally, its capital to risk asset ratio, that is CRAR, is at 49% despite going through a tough year. Its cost to income ratio has improved quite considerably from 61% in 2018 to 46% in 2020. However, the last few years have been tough for the housing finance companies. First, demonetization followed by IL&FS crisis, then COVID, which led the economy to a grinding halt. The pandemic impacted Home First too, since it witnessed an increase in bounce rate from 10.5% during the last quarter of FY20 to 28.3% during the second quarter of FY21. Maintaining bounce rates at lower levels remains a challenge for the company. Secondly, there is also a risk of decline in value of its collateral. Any adverse market conditions in the real estate sector materially deteriorate the value of the collateral, which is another risk. And lastly, all housing finance companies have faced the brunt of COVID-19, but most of the pain has taken a backseat due to proactive measures taken by the RBI such as moratorium and restructuring. Unless and until the true picture on the moratorium and restructuring of loans do not come out, we cannot judge the real impact of COVID-19 on these housing finance companies. So, this remains a major risk for the company too. To conclude, in terms of valuation, Home First Finance may look attractive at a price to book of 4.1 compared to Awas Finance 6.7, but it still remains well above the country's best housing finance company HDFC Limited's price to book of 3.3. Therefore, due to the above mentioned risk and uncertainty regarding moratorium and restructuring of assets, we recommend investors to subscribe to this IPO for listing gains only. Thank you.